On the surface, retirement planning hasn't changed all that much over the years. You work, you save, and then you retire. But while the mechanics may be the same, today's savers are facing some challenges that previous generations didn't have to worry about. First of all, life expectancy is longer, which means you'll need your money to last longer, potentially into your 90s. Bond yields are also much lower than they used to be, which means you can't buy a few fixed income instruments and earn a double-digit return. Then there is the health crisis due to the coronavirus pandemic. This is compounded by the fact that more companies are moving away from defined benefit pensions, which guarantees you a certain amount of money in your golden years, to defined contribution plans, which are more subject to market ups and downs. So how can you have the retirement you've always wanted? After all, retirees want to experience all the things they couldn't do when they were too busy working. Exotic travel vacations, marathon running, novel writing, spending more time with friends and family. The possibilities are almost endless. There are several steps, which we explain in this retirement guide, from budgeting and setting goals to choosing the right retirement savings account that will help you map out a plan that's right for you. Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. How much do you need to save for retirement? One of the hardest parts about preparing for retirement is thinking about life as a 70-something. A lot of people get so overwhelmed about saving for an unknown future that they end up not saving anything at all. Thankfully, planning for retirement is not overly onerous, but you will need a roadmap, one that can evolve over time to keep you on track. The first place to start is to think about what your life might look like in retirement. Sit down with a pen and paper and write down your retirement goals. Then think about how much everything will cost. We don't know what prices will be like in the future. And in recent years, inflation has run below the Fed's benchmark of 2%, but the average inflation rate in the US over the past century, 1913 to 2013, was 3.22%. So, plan for higher prices in the decades ahead. You'll also want to factor in your day-to-day expenses, like housing costs and food and healthcare. Remember, some of the costly expenses you have now, such as mortgage or childcare costs, will no longer exist, which could result in a decrease in your overall expenses as you near retirement. Next, add up all the income you might receive in your post-working years. Factor in pension income if you have one, Social Security payments, and any other dollars, such as rental income from a property that may have come your way. Match up revenue and expenses, and you'll get a good idea of what you'll need to set aside for every year of your retirement. Here are some things you should factor into your calculations. Housing costs, including rent or a mortgage, heating, water, and maintenance. Healthcare costs. Day-to-day living, such as food, clothing, transportation. Entertainment, including restaurants, movies, plays. Travel, including flights, hotels, gas if driving. Possible life insurance. What's the magic number to hit for a golden retirement? Over the years, financial experts have said that people need to save $1 million. That's recently climbed to $2 million as the cost of living and age demographics have changed. Some advise that you need to save 80% to 90% of your annual pre-retirement income, or that you need to save 12 times your pre-retirement salary. Those numbers and formulas can be a guide, but they're not gospel. Everyone's situation will be different. While starting early is always important, and it is true that the earlier you start, the easier it'll be to retire on time or even beforehand. Putting aside $25 a month in your 20s is helpful. It's okay to set money aside for more immediate needs first, and then start tackling retirement in your late 30s and early 40s. However, you don't want to wait much beyond that because you'll need time to put money into a retirement account for that money to grow. The longer you wait, the more you'll have to sock away yearly, making the challenge a lot more difficult. Things to keep in mind when getting started. Create a budget. This is your current budget, which takes into account all of your present-day income and expenses. While you should have some idea as to what you'll need to save per month based on your retirement goals, you also need to make sure that you have that money to save. It's a good idea to put retirement savings as a line item in your budget, just like food and shelter costs, so that you can set aside those funds every month. Create an emergency account. Having a separate emergency account, usually with about 3 to 6 months of salary saved up, will allow you to cover any unexpected costs without throwing your retirement plans out of whack. One goal for everyone should be to reach 65 debt-free. That includes credit card debt, and especially the high-interest reward card kind, car and mortgage loans, any student and other big loans. The reason is simple. You don't want to be going into your non-earning years owing money. What investments account should you use? Setting aside a certain amount of money every month is, of course, the most critical part of retirement savings, but you won't reach your goal without putting that money into the market. One reason to invest is because you want to take advantage of the power of compounding, which is when gains grow on top of other gains. For instance, if you invest $100 in 1 year and it goes to $110 the next, your next year's gains will be on top of the $110, not the original amount you put in. So over time, that compound growth can really boost returns. No matter what account you use, your investments will compound year after year. Losses can compound as well, but fortunately over time, markets have climbed. How much you can save and what tax money you may have to eventually pay, though, does change depending on the account. Accounts you can use for retirement savings. A high-yield savings account. It's risk-free. Money inside of a federally insured savings account does not get invested in stocks or bonds, but you'll make next to nothing on the funds in the account. Currently, the highest yielding savings accounts are under 1% on each dollar invested, and that has been trending down with current Federal Reserve policy to keep its benchmark rate lower for longer. Your money should grow more over time in a more traditional investment savings vehicle. How to invest for retirement. Years ago, retirement-focused investors would have likely put their money in a balanced mutual fund, which typically consists of 60% equities and 40% bonds. While that asset mix is still popular among savers today, you get some growth from stocks and some protection from bonds. Investors now have more choice. So here's a look at some of the more popular investment options. Stocks for growth. The majority of savers will buy stocks, either directly or through a mutual fund or exchange-traded fund, which are shares in a publicly listed company. Stock prices tend to rise over the long term, which is why people buy them. Since 1926, the S&P 500 has posted a 10.24% average annual return, according to S&P Dow Jones indices. In other words, if you invest in equities in your 30s and retire in your 70s, there's a high likelihood that your money will have grown over those 40 years. The downside is that stocks can fall. In the Great Recession of 2008 and the more recent pandemic stock market plunge, stock prices dropped by more than 35%, which caused a lot of problems for those in and nearing retirement. Fortunately, while all stocks fluctuate in price, there are a lot of different kinds to choose from depending on your risk tolerance level. If you're a more aggressive investor, you might tilt a stock portfolio to sectors with higher growth potential, but also more volatility, such as technology, while more conservative investors might focus on blue-chip companies in sectors such as financials, consumer staples, or industrials, where there traditionally has been less potential for the bigger gains, but also less volatility. But all stocks carry risks of losses, and volatility profiles have been changing in recent years. The best way to limit exposure to stock volatility is investing through a diversified exchange-traded fund, known as an ETF, rather than single stocks or narrow sector investments. Bonds for safety. Bonds are another popular investment for savers, as they can move a lot less in price than stocks. Investors lend money to a government or company in exchange for an annual payment based on a predetermined interest rate. At the end of that bond's term, usually between 1 and 30 years, you get back your original investment. Investors like bonds for two reasons. They get some guaranteed annual income, and there's less risk, depending on the kind of bond you buy, of losing any money. Because of this, bonds tend to fluctuate less than stocks, so they balance out a portfolio's overall ups and downs. But bonds aren't perfect, however. First of all, there are different kinds of bonds with different risk levels. Generally, treasury bonds, which are fixed income securities issued by the federal government, have little risk of defaulting. Even with America's high debt load, they're going to pay the interest on their loans. The same can't be said for certain municipalities, which also raise money through bond issues or companies that may be in financial trouble. If an issuer defaults, your bond could be worthless. As well, these days, interest rates are so low that you can barely earn any money from holding fixed income. Also, when bond yields rise, prices drop, and vice versa. If you need to sell your bond before the maturity date and yields climb, you'll have to sell it for a lower price than you bought it for. There's something else. Most individuals don't hold actual bonds. They tend to own bond funds. which hold a number of fixed income instruments, as buying a single bond is difficult for the average person to do. That fund's value could fluctuate depending on where interest rates go. With rates so low, many people think that at some point, interest will have to rise, which could negatively impact the price of your bonds. Still, if you're worried about the stock market at all, then bonds will usually help smooth out the ups and downs. And with that, we've reached the end of this episode, all about the top tips on how to plan for retirement. Are you planning to retire early? Get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.